So welcome to the meeting, and we have Dan Queen, who is a local trader here in the area, and has trading now full time after having retired from a career in telecommunications. We have a lot of telecommunications here in the Triangle in North Carolina, and a lot of people who have that background. There's a great background for trading. One of the most basic and important themes of trading is to get started on the platforms, and Dan is going to cover, or he uses both Thinkorswim, which is the most popular single option trading platform among our members, and also tastytrade. And Dan has uses them both, and he's explained before, but I know he'll maybe mention again some of the reasons why. But we'll cover trading from a hands-on point of view using those platforms. Be suitable for people of all levels. We welcome questions, and I will hand it over to Dan. Please go ahead.
Okay, thank you, Don. I appreciate the opportunity to speak again, and we'll get into the presentation now. It's a continuation of where we left off early this month on the 2nd, and we'll go and have a go at this one. I'll take and early on have a review of where we are, and then we'll talk about some new material after we brought all the newcomers up to speed on what we covered last time in a faster pace, of course. Okay, so option trading is definitely not to replace your core investment, but a supplement to it or enhancement to it. And I treat each account independently based on the size of the capital that's in there. So this talk, we're going to, again, go over the basic building blocks quickly that we covered last time, and then move along into probability, volatility, and how that affects the price of the options, and then look at how time affects those options, as well as trade setup and analysis of those trades. And then the interaction will be along the way and via the chat, or as Don said, just speak out and open your microphone and shout it out and stop me in my tracks. Okay, here again is my background, and I covered that last time. And as Don said, I've been at this basically since 2012, and I've used several different platforms, but have settled in on Thinkorswim and tastytrade. Now, I showed this slide last time, but Tom Sosnoff and Scott Sheridan and Tom Poston, they originally did the Thinkorswim platform, and then sold it and started the Tastyworks there, and then now that is evolved into tastytrade. So it was an easier transition for me because of their way of thinking about the way they built trading platforms to use both of these. And if I would look at them at a very, very high level, I will think of Thinkorswim as a Swiss Army knife of trading platforms, where you got lots and lots of features there, and you can usually find the right tool. And tastytrade is now maybe an easier platform to get introduced to because of its style, and you can maybe see some of that as we go along. Okay, so this is my disclaimer there. This is for educational purposes, and I'll only gain investment of my time whenever you learn to do something new. gain a new point of view. So I've not received anything financial or barter from anybody. So this is the opinions expressed are totally mine, but I want you to form your own opinions and do your own trades based on your own comfort zone and ability to see profit. All right, this slide, I combined a lot of things there to start us on our presentation here. So one contract is 100 shares, and you buy it, you're long the contract, you're sell, you're short. And the long side offers you the right to buy that stock, and the put contract, long put contract, the right to sell. And emphasize that word right, because when you turn it around and you sell a put, it obligates you to own shares of that stock. Or you sell a call contract, it obligates you to borrow short those stock shares. So these little diagrams were from last time. I got a different set there, the profit zones for the various legs, and we'll cover those a little later. We had a little bit of questions on those from last time. I've tried to enhance those a bit. Okay, so the Greeks we'll be talking about is, you know, the delta, gamma, vega, and theta. Delta and theta will be the two primary ones. And the idea of delta being you presenting a share equivalency or direction or probability of in the money. It also offers you if you take the delta, you can project how often that strike will be touched. Gamma is something that we don't talk about much, because I usually try to stay clear of the expiration date and get out of the trades well before that. And then vega is just a measure of the how sensitive it's going to be to the implied volatility, and theta simply measures the time value of that particular option. All the options on the day of expiration are worthless, the options themselves, but they have consequences. So, showed this one last time, but you have to selling or buying. Well, when you sell an option, you have two ways to win. If the stock stays the same, or stock goes up in the case of the put contract, or vertical. We'll talk about what a vertical is in a minute. And the call contract, if the stock goes down or stays the same, you make money. If you buy it, you have to be right in the direction and have the movement in a certain amount to be profitable. So to put a little bit better emphasis on those ideas, the short naked put up in this area, if you sell it at this represents the strike price in this area. The little circles are the current price. So you sell this put contract, and the price can move as long as it goes and stays in this green zone. It can even go and breach the put, and you can still make money before the contract expires, all the way down to this point, and that's the break-even point, and it turns red. Likewise, if you sell a call contract above the current strike price, the price can go up, and you're still profitable all the way up until the price that you sold it for is, if you sold it for $1 and this is a $10 call, at $11 would be the break even. Now, on the long call side here, you're buying the contract, let's say, at this point. And to make money, you're going to have to go above increase in price all the way up to this point, and then you start making money. So if you sold the 10 contract, you'd have to be above $11 to start making money, and you could make money all the way up infinitely. And I forgot to mention the downside of selling a contract above it here, a call contract, is that this loss can go on for infinity. Now, on the short put side, the contract that you sold, if you had one contract, you'd be put the 100 shares of stock if you held on to it, and then if you kept that 100 shares of stock, they could go to zero. But that's no different than holding a stock. Now, if you wanted to take, I guess I didn't cover the long put side. If you wanted to do a long put, same thing would happen. You want the stock to go down in price. Like if it was a $10 put again, you'd want the price to decrease to $9 before it goes and expires. Now, of course, it could only go to zero, so you're not going to get an infinite number there. Neither is rarely do stocks go to the moon either. Okay, if we put two contracts together, we've got a short strangle in the case of selling a short put below the current stock price and selling a short call above the stock price. Now, if you want to take and sell both the put and the call at the same stock price, that can be done. But in this case, you'll always be managing one side or the other. One side or the other will always be in the money. Or you could either be short calls, or you'll be short the stock or long the stock if you let this position go all the way to expiration. Whereas the strangle, as long as your price stays in between the short put and the short call, you'll be profitable. 100% profit. If you collected $2 on trade entry, you would keep all of that $2 at expiration. Okay. Last time we talked about equivalency.
Dan, could I interrupt you for 1 sec?
Yes.
Before we move on, there are a couple of questions in the chat, or actually,
okay, go ahead.
Question and answer. So, but maybe you might want to comment before we move on to another area. And also, I have one point that I would like to mention, and that's when we say sell here, we mean sell the open. There may be some people who want, I think most people are familiar that in options and even in stocks, when we say sell, there's two different meanings. Sell something you already have and sell something you don't have, short sell. And in this case, we're talking about selling to open. You're selling it naked, and that's just so common in options that we just take it for granted.
Good point. Last time I even had a slide on jargon, and when we say what's the width, and we miscommunicate between what's the width of the iron condor strangle or whatever. Anyway, that's a good point, and I was getting ready to talk to the idea of equivalency here, and Rocco last time put forth a little, it's down there at the bottom here, this the stock price is equal to the call minus the put. Well, that's good. That's great. I had heard this same equation expressed slightly differently, and it's called CUP, where the call is equal to the underlying and the put. And so that's in the box down here. And you can just do your algebraic transfers. If you remember your algebra, you jump over the equal sign, this put long on this side. If you put it on the other side, it's a negative. And so that's what this is. So a call, I think where we got before, we decided we were talking about short equivalency. And so you would buy a put and sell a call. And we went and did some of that in the platform. And we can do it again if needed. Okay. I guess we've already talked about theta. I'm going to skip over that slide. This one's more important. So if you remember the slide before with the profit profiles, the little dot was put arbitrarily there at the contract. So if you sell at the money, it will have, that means the strikes nearest the current stock price, you'll get a decay curve that looks something like this in time. Now, if you sell out of the money options, the decay curve will happen much more quickly. And that theta we just talked about, if you sell the option and it decays, that means you can buy it back at a lower price. So it's just buy low, sell high, but in reverse. And then the in the money options are in the middle. So that was my question, stopping point. Let me see if I can find the.
Perfect. A couple of people are asking in the chat or discussing the relative advantages of selling a put naked or buying a put. Let me get this straight. Of selling a put versus buying a call. Is that the question, right? And the people are discussing again, which is a better means. Well, I'll let you read them yourself.
Yeah. Okay. Well, let me see if I can. I thought I had it here. Chat 17. I'll move that off.
I mean, basically, there's a big difference. I'm just going to say, let's say you're bullish. And there's a big difference between buying a call and selling a put. Those are both bullish positions, but there's a radical difference between them, and you have to understand it.
Okay. Well, I like to demonstrate those questions without actually going into the platform. You want me to jump into a platform?
Sure.
And then we'll get back to this. Let me see if I can get this here. All right. Can you see that? Probably.
Yes.
Let me
It's
do
a little
something.
fuzzy, but
Let me flip it to general. Maybe that's better.
so this is Tasty Trade, which is one of the two major platforms that Dan is suggesting
Yes, it is.
trading on.
I was trying to go and get the scenario here. What the question was between the two. Was it selling a put?
So we have the puts on the right
Yes.
and the
There's
calls
the
on the
puts.
left. Is that right?
Yes, that is correct. Just like toss. Okay, and so this let me click analyze. There we go. Let me get rid of that. There we go. Okay, so that's a long position. Equivalent.
In the stock itself.
Yes, as opposed to buying the stock, I could sell this put and buy the call. And to your point, Don, this says buy to open, BTO, and STO. It's red. It's hard to read, but that's sell to open.
So you're synthetically creating the equivalent of a long stock position by selling a put and buying a call, and that's exactly equivalent to having the underlying stock.
Now, got this little thing, this feature here. I can do swap. Okay, and it flipped it. So I bought the put and sold the call.
Which is now exactly equivalent to a simple short position in the stock.
Yes. Now we flip it back over to table. And you see I'm far from the money. Well, not far. The bar there will be in the range. I can move the strikes down here. And so that's right at the money. I'm going to flip it back over again. Go back to curve. And that would be equivalent to the stock. Okay. So there's equivalent.
Okay, perfect.
Yeah.
Thank you.
All right. Okay, I don't know whether that cleared up the questioner's question, but you can go into the platforms like that and play around with it, and it usually immediately becomes clear. Okay, we've already made that there, and I did not repeat here the pattern day trading rule. We covered that last time in some detail. And meaning if your account is below $25,000, you can only trade 3 times per week. And it's really a penalty to the small trader there that's just getting started. But there are some workaround rules on that, or workaround methods that we discussed last time, and I won't repeat those again here, Don. Okay, let's talk about probability. This is basically where we were left it, and the idea of excuse me, which side do you want to be on? Do you want to own the table or the machine or the insurance company or something like that? Or do you want to play the game? And usually these games they're all have some advantage to the house. And this roulette table here, notice it's got 1 0 in this one, 2 zeros in the middle one, and 3 zeros in the last one. So land on those, house wins. So all of these, the probability is not in your favor. If you play long enough, you will lose. And some other examples, extreme examples of poor odds, is the lottery. And I know it's fun to spend a little and hope you make a lot, but it's not very probable. So as I mentioned, premium sellers could be equated to insurance companies, landlords, and of course, casinos. Now, probabilities, where they come from. So when time intervals gets very, very small, this becomes kind of a 50-50 chance on whether the ball comes down and bounces right or left. But over time, you'll get a normal distribution of each one of these bins with the number of balls in there. So that's a way of looking at it, and typically it's measured with a normal distribution and percentages. And so that expected move that people talk about, it's really 1 standard deviation, and sigma is standard deviation. And mu in this case is the mean, or the middle, meaning there's just as many recurrences to the left as to the right. Now, so that 68.3%, that covers your 1 standard deviation. And in the world of options, everything usually is quoted around those upper bound and lower bound. So getting out to a second sigma here, or standard deviations, usually the buying power, or what you're charged, that you lose capital for that. Not lose, it's a bad term, but your buying power is removed from your account so that you can't use it up to a point. And if you get over that buying power, it will have to add more money or sell something in your account, or close trades to get the capital back. Now, usually that boundary is at this two standard deviations, the amount of money that you've been charged. Now, this last above that point, it is going up to 3 a standard deviation. So 99.7% of your occurrences will normally be in between those bounds. Now, of course, stocks can go infinitely high, or they can go to zero. So on this side, you're bounded by zero, but on the right side, you're bounded by however high the high is. Okay, now TOS has a simulation of that, and we'll talk about that later. But you can think about this when we get to it. Think about this curve, but we flip it on its side. So the low prices will be on the top, and the high prices will be on the bottom. Okay, go to the next one. Now, these extreme losses here, there's ways that you calculate the profit. Well, what about the loss? What about this area and that is very, very high or very, very low? There's this thing called custom or conditional value at risk, and that's on the Tasty Trade platform, and we'll talk about that. But it's the average loss beyond the value at risk level. This is in the middle would be your area of your normal profit zone. Well, what's a dollar figure of the worst 5% here that accumulates? And we'll illustrate some of those points. Now, the trading platform itself is laid out with strikes going from the low to a high. And that is based upon, I think, because of the way people wrote numbers down on a blackboard when they first started trading. So again, this probability curve, normal distribution, if we rotate that, that puts the low side at 1 and the high side at 20. So the regions that we're talking about will be out of the money region. That will be the put strikes that are below 10 in this case, and the call strikes that are above 10. And so these are the regions, the out of the money regions is the preferred areas to trade, because in the case of a call, if you're short an in the money call, you have an assignment risk. If a stock pays a dividend and your value is less than that dividend, you will likely be exercised, so they get that difference. And also, it's lower liquidity on this side and wider bid ask. So if you're trading in the money, you'll have more slippage when you're in these two regions. Okay, so the term that we had used already and didn't define it was this area would be at the money, or ATM. And then as we go down further on the put side, this would be far out of the money or deep in the money. Likewise, on the call side, you'd be deep in the money on the call at a low value, or far out of the money on the call on the out of the money side. Okay, so let's go back to the platform. real quick. Find it. Okay. There we are. And maybe I can help us out. I'm sure that's a very small screen. If that helps us. Hope that's better. Okay, so this would be the out of the money side, and out of the money side for the call side. The shaded side are in the money. So if we put a, oh, excuse me, didn't mean to hit that. Okay, here's the example of the strangle that we had before. Let me see if I can. All right. I was going to illustrate the idea of I don't know why I'm not getting a CVAR number on this one. Should get it on the SPY.
So you're selling a call and a
Strangle.
put,
Yeah.
which is a
just
strangle.
strangle. Okay, and it gives you, I'm selling it for $16.85, but the buying power to hold this is $8,000. But this is a, you know, nearly a $500 stock, very large stock. So that outer region, that 5%, is $7,000 if you get it. But on your probability of making 1 penny is 61%. So you've got better than a 50-50 odds on making this trade. Or if you make it 10 times, you're likely to hit 6 out of the 10. Now, if you want to settle on half the profit instead of collecting all of the 1685, and you want to settle on half the profit, that's what this P50 number is. And the platform goes about a Monte Carlo simulation, meaning they back into it with the various paths that are likely to yield that 50%. And it comes up with an estimate of 71%. So those are, I'd like to see whenever the odds of making half are higher than the probability of making a penny. It's just a quirk of mine. I just like those setups. So also, if you've made 50% and you're, what is it, 16 days, if you've made 50% in 8 days, I would certainly close the trading, try another one of some other, either another time period, collect it, and because if you stay in the trade, you're risking it, of risking what you've already made. Okay, is that kind of clear on that particular point? I'll go back to the.
Sure, I think so. I mean, I guess we should say, Dan, and just to give you my opinion, that these odds are just based on the current pricing of the market. They don't really reflect any insights beyond that. So if you have an opinion that an election is, well, that, you know, the world is going to collapse tomorrow or something, then these don't mean very much.
Absolutely. And another important point is the number of attempts you do. A small number of attempts or occurrences don't yield a very nice looking distribution. Or in other words, you can flip a coin that's 50-50 and you end up with a lot of tails or a lot of heads before you get that 50-50 mix. We'll try to show that a little later. Okay, so I think we've mentioned that, and we could have showed that back in the platform, bid-ask spread differences, but you'll notice it whenever we go back in again. Okay. In the platform, I won't spend a lot of time with this. We showed it last time. I've included it again, those areas that we were looking at, which is, I enjoy seeing the expected move is that orange bar of wherever you or whatever you're looking. As you advance it in time, that orange bar grows. In this case, another strangle, 175, 210. Strangle and some of the numbers and showing the CVAR again. Now, the dotted lines are that standard deviation region. This dotted line and this dotted line. So these are regions, and they typically occur about point deltas of 1.5 or so. It's a second deviation line is region. It'll be at this level and down at this level. And this is in the table view, and we were flipping from the curve view to the table view back and forth. And we'll talk about IV, and they rank, this IV rank is prominently up there at the top, and the higher usually the better. Okay, so that expected move, we showed this last time. If you wonder how it's calculated, it's with the 3 at the money straddles or options there in various proportions, and you can work that out if you want to, but I usually trust it, and it's usually real close. Again, there is a slide included. I think we talked about it last time, and these regions, I left it in this time, talking about how the analysis tab or the curve mode with this analysis. And Don, your question, or you can go in here and change these dates and see the curve move. You can do this in TOS also with their Analyze tab also, of course. Okay, here are those definitions there of those boxes. All right. We went and talked about put call parity last time, and I'm repeating it here. And I think we can say that the areas before, you can look at this in the same orientation as the layout, is that we've got a extrinsic value. If you sell a call, it's all extrinsic value. Now, if you buy a call, it's extrinsic value in the same proportion above and below, plus the intrinsic value, or the distance you are from the current stock price and the added to that extrinsic value. Extrinsic value is dependent upon implied volatility and other factors there. As you can move further and further away, your intrinsic value in gray is increasing. But this is, as you move along, it's basically all of the same number. See if I can flip back over here. Okay, there's what we had before, a long stock equivalent. Oh, didn't want to do that. If you select it in blue, it moves it. I just want to move both of them at the same time. There we go. See my delta down here? This delta number is basically the same as we move it up. Now we could take and the extrinsic number is basically, you can see the difference in the extrinsic values here. And the difference of this is extrinsic, and then the intrinsic value is just the distance that the strike is from the current price of the option, in this case, 492. As before, we just X'd out these two because of what we said, that they were less liquid and you were exposed to assignment risk in this quadrant and this quadrant. So let's talk a little bit about how this extrinsic value works. So the time to expiration is a big component, as well as the implied volatility. and then the interest rates and dividends changes. If you see something that this put call parity breaks, where they're not equivalent, usually there is a dividend about to be paid that you should be aware of and avoid. But again, that's only in the case of having the short call in the money. So a little note on orders. So if you just place the trade and don't lock in the price, you'll get the current price on the platforms. A limit order, if you've locked the price, you usually buy an order that is below the current market price or sell order that is above the market price. Now, if you're just trading one lots, you don't have an issue of a partial fill. But if you're trading like 10 contracts or 20 contracts, sometimes you get the issue of a partial fill. Usually you get it all at the same price over time because it's a limit order. But sometimes they actually give you a better than you're asking or you settle for, and not all the prices will be identically filled, but it's usually be what you've put your order in for or better. Now, this is a toss chart, and it is a probability cone. And when it defaults there, you will get a 1 probability cone. And I have added this one 2 more, one for the standard deviation, and I think the orange is, yeah, it is down here. The orange is 1.5 standard deviations, and the purple is 2 standard deviations. So this gives you, at whatever price points you're talking about, a range of pricing that you can equate to where your particular strike is going to be.
So what is this showing us, Dan? Is this showing us the expected value at within a certain time period?
Right. That expected move would have been between the 1 standard deviation expected move
of the underlying in this case.
Of the underlying. Well, this is exactly the statistical 34 up, 34 down percent, to 68% would be this particular number. Now, the expected move calculation is as we showed, but as you move out in time, it gets wider and wider. And let me go back to this particular one. Let's go back. Oh, I didn't do. How about that one? Can't shrink it down anymore, but maybe I can do it this way. I'll go down in time. See, as we're going down, it's getting 14 days. See the expected move, the brown bar. It's smaller. 13 days, smaller still. 13 days, smaller still. Went up on that one 12 days. You know, SPY has a lot of individual options, even down to the day.
Can you show me where the expected move is on this chart?
I haven't put a trade in. Well,
Oh, I
yeah, I
see.
did. Yeah, okay. I do have a trade, and it's not even on the, it's, that's better. Now, you asked for the expected move is right here to here. The brown
So you're
area.
saying, okay, and how does, where the dotted lines are, is that right?
That is, what I'm saying is it's not quite to the standard deviation for the way the calculation is working, as I showed you the slide before, with at the money, I think it was 60%, and then the next out of the money straddle, they would have done this one. Let me kill that one, and it would have taken this one and then this one. I think that was 10%, and summed all those up, and that would have given the expected move. Now, the standard deviation, the region, as I said before, is the two dotted lines, just to give you a general idea of where this one standard deviation is and two standard deviations.
So basically what you're saying is you look at these measures, whether they be standard deviation or expected move, and basically you're saying maybe place your short option legs outside those
Absolutely.
values in order to increase the probability that the trade will be a success.
Yeah. Yes. Like in this one, it's 60% and 50%. Personally, the larger, the better. Okay. Well, here we are at one day. Let me go back up in time a little bit. And opened all these things up. There we go.
So you're showing that the bands are much wider as you increase your horizon, your time horizon.
Yeah. Well, yes. And the 446, that's right at the money in this case, or at the edge of the expected move, and the standard deviation level area would be all the way out here.
So if you're selling a 14, or you have here a 9-day, so if you're selling a 9-day strangle, then this is where you might want to place them.
Okay.
Whereas,
Yeah, I'll have to apologize, Don, because I clicked on this one, which was a 9-day, and it opened it up. I'm going to clear out this trade and go clear. And then we'll go into
it doesn't matter. It's just the idea.
yes, and okay, and here we're much further out, but back to the it's a very close approximation of what the moves are. It allows me to click on the option, and then I have to look at a different place to figure that particular one out. Okay, I'm going to go back and go to this guy, and we'll go to the next slide. Now, what I also use this particular cone for is to spot anomalies. This spread or cone looks like a rocket if it's on the sides shooting through the air, and it's got a plume coming out that will keep that rocket on course. Here is an AMC example. And look how the call side is way, way out, and it's smushed here. I wouldn't make one of these strangle trades in AMC. It's so undependable, and you know the story of AMC and their reverse stock splits and other stories. And so that's just another. I did look at NVIDIA. Don't think I did the NVIDIA, but NVIDIA also looks a little suspicious, but it's a very new stock that's only had options, what, a week or so. Now, pointed out on this area, this is the implied volatility. You have an earnings announcement, and your volatility just gets crushed. And that's what we can trade on, is getting some volatility crushes.
So how would you trade that?
I would just pick out a strangle or any short option. And the day before, maybe we can get to it. I actually did a couple, and we can show what we did there.
But basically, you're going to wait till a certain point in time, and then you're going to sell in anticipation of the collapse of the price.
I was thinking I had one. Let me see if I got. Okay, I put on this data general position today and sold it for $1.45. And here's that position. Okay, it's only 2 days to go, and I think it announces in the morning before they open. And let's go to the curve mode. And it's one contract on this account, again, because it's a smaller account. And if we advance it 1 day, There we go. Looks a little bit better. Okay, here's today. And here's the closing stock price, I think, 154, yep, around there. Step ahead to tomorrow, one day. So it should be profitable from, you know, this would be the region of profit. Now back over to the, it's like what, 145, 167. Go back to the table. So 145 to 167, it will be profitable tomorrow. It stays between those approximate ranges. I don't know, did that help, Don?
Yeah, so
how
in other words, yeah, I mean, John has a question too. What have been some of your worst earnings trades been while short strangles?
Oh, I think I did one that was I had the stock. I looked like it was profitable on a Friday, but they had the announcement. Who was it that announced on a Friday? Was it NVIDIA?
Yeah, it was like last week.
Yeah.
Gosh, who was that? I was looking at them too.
Yeah.
Palo Alto.
Yes.
Palo Alto
Correct.
Networks.
Absolutely. Yeah, they had this meeting over the weekend, and so that they could talk about it freely, they made their earnings announcement after the close on Friday. This never happens. Well, obviously, can't say never because they did it. Anyway, it's not likely to happen. Yeah, what's the probability of that? Okay, but it happened. Well, it closed within my bounds. I would have been 100% profitable. However, the market stays open past and allows trading to occur past the 4 p.m. close until sometime later in the evening. Make a long story short, I got assigned the stock. Okay, and I had to immediately counteract that because guess what? I did it in a IRA account, and you were not allowed, and it was assigned short, and so you're not allowed to hold a short stock. So, but I managed to wiggle out with just a little bit of loss. So that was the worst thing that happened to me, where I felt that I did not know what was happening, but it can. Rare. Now,
Dana, if you'll allow me to press you on this, it just seems so improbable that your short strangles and straddles with possibly unlimited loss, and one of your worst trades was only a very small loss. What are you doing to filter these so that you're not open to these unlimited losses?
Okay, well, I usually manage the trade and immediately roll it out in time, and usually change the positions. Now,
okay, so you take a loss, you take an immediate loss on your short-term dated expiration, and you create a new trade to try to gain back
think I had maybe had an example of that. I'm going to click on it. Okay, I'll let me shut this down. This is in the slide deck. Can you see this one?
Yep.
Uh-oh. All right, Airbnb. That was one of my trades. And this is a feature that they have in Tasty Trade called order chains. And it basically keeps tabs on your orders. So I put it on 214 and I closed it on 3.3. And the 194 was my collected profit, and the this is the IV rank delta. I don't really have the, let's see if I have the price on it. But anyway, I got it breached there, and so I only had 3 days. So I rolled it out a week essentially on 215, and so I bought back the 2 days and sold the 117, 133. So I rolled up the put. Can you see that, John?
Yeah.
Okay.
Yeah.
Okay. And then basically I did another move on the 15th, collected another 70 cents. And then collected another 375. And then essentially closed it out, and I made $600. Now, what do you do in the case of a black swan, if that's what your fear is?
That's a good
Yeah,
question.
not a yeah.
Yeah, and it took me an extreme amount of time to get over it. Now, can it happen? Yes. But I think that I can close, roll, or mitigate the trade by doing some of these techniques. Now, if somebody pushes a bomb, you know, we have a nuclear attack or something like that, I'm not going to be set up for it. Now, I also stay extremely small relative to the portfolio size.
Now, just, you know, so I can understand the trade. Is it a short put and a long, a short put?
No, it started down here at the bottom on 214. So short to open 106, short to open 133.
So it's a short put and a short call?
Yeah, it's a strangle. And then I rolled them up.
And this is like the typical trade you do for earnings.
Yes, or anything. It doesn't matter whether it was for a 1 day or 45-day trade. It would be still the same similar technique. Okay.
I mean, you could use a protective long, right? Protective longs. You should.
Absolutely. Okay. My experience with that is, and I do that in higher priced stocks, because the notional value is too large to hold it. So you buy the wings or the long protective wings, buy a long call and a even further higher up, you know, and we can demonstrate some of those.
And that's an iron condor. Well, is it?
Yes, exactly. Now, maybe that didn't work to totally satisfy you, but that is where I've been so far. All right, let me go.
No, I mean, you're still here. You're still trading, Dan. So props to you.
Well, staying small, you can handle it. But if you try to get greedy and get, oh, this worked, it worked, I'll go 10 times bigger this time. Well, guess what? Trade the size or the tranche size that you can handle, and get a lot of occurrences, different stocks.
I think we need to make sure that people understand this trade. Do people understand what the trade is? In other words, this is an earnings trade. You place it right at earnings announcement date or right before it.
Right before it.
Right immediately before it. And you're selling out of the money calls and puts on both sides because you're saying they're ludicrously overpriced because everybody has incredible expectations, and really nothing that much is going to happen probably most of the time. So it's a great opportunity to sell some premium. So we're selling a put and a call. Do people understand that basic trade? Nancy says, can you explain how to place it?
Okay, let's go back to the platform. Let's see here. Where's the date? I blew it up so big I can't see the date. Dividends. Here it is. Very last column. Earnings day. Here's the earnings day, 8/31. Remember, we're talking about Dollar General. Did a trade on that, and it's 8/31, and it's before the bell. And after the bell was a COO, and it's already occurred. So that's been announced. So if we take Data General, and we went over this before, that's the way I placed the trade. I sold this one, or this call above, and the delta value was a 10. So looking at delta, you can say, well, there's, as a percent of it getting in the money, is about 90. You can not go anywhere else, but I can look at, I think it's got a percent in the money number, and we'll compare it. Actually, the calculation that the platform's giving us only has a 4% chance of this strike being breached.
So those are pretty low. So basically the calculus is you're going to go ahead and sell something that only has a low chance, like 4% of being attained, being reached, and therefore should be golden.
Yeah. So, and on the put side, it was this particular strike, the 139, and it says, like if I'd used delta, I would have said, 8%, and it's calculating a little bit better at 7%. So that's where the confidence comes from. Now, if I was much closer there, I traded off the price that you get to the actual my premium for probability of success. Okay, actually put the order in again. So right now, this price is, I put it in at 145, and I'm actually underwater a little bit between 145 and 58 cents. Oh, yeah. So if I go back to my position here, it looks like I'm down $13 on that position.
Do you close it or you let it expire worthless?
Oh, I will likely close it. Like, let's go. Okay, let's do that. Let's go. I'll close it, and if I want to get 50% profit, there's 50%. I click on that, and it calculated it for me at 73 cents, and that's the debit. So I sold it for the 145. Want to buy it back for 73 cents. Hit review and send, and voila. And it might get filled at 9:30 and 15 seconds. Well, we'll see what the expected may be, because I should well be within that. It will fill. I never say will. It will likely fill before it closes tomorrow. And I don't have to do anything else. I can go about my business.
So are you moving out the strikes? Is that what you're doing?
No, I just closed the trade.
Oh, I see.
I just closed the trade.
Why? On the rationale that what was the rationale for closing it?
I made 50%.
Okay. Excellent.
Take the money and run. Now, in fairness, I don't do exactly this. I will get greedy and say, okay, I will likely, I'd like to have 75%, and I would put this trade on for at 75% profit. And then I don't really get hit and get taken away in that last little bit. And then since I'm around watching this stuff all the time, I will go in there early tomorrow morning, check to see what the stock's doing and where the bids and asks are happening on the options there, which will be likely a minute or two into the trading day, and then adjust the trade. But oftentimes I get hit right at the 75% level, because if the stock doesn't move, there's a big crush in the IV. Like,
So so do people understand the trade? If not, please speak up, because there's no point, if we're leaving people not understanding. We've got to fix that.
Yeah.
But in general, just to follow up on John's question, so these are trades, like these are your bread and butter trade. You do them all the time, these earnings trades, and they rely on standard deviation and expected move and so forth, which is why you went into those things, just to explain to people. So, and these are some of the mechanics you use in placing the trades. But the question is, do you believe, have you found it profitable overall? And do you believe other people would be able to duplicate that success?
I would start with putting in the wings until you're comfortable with, put the training wheels on the straddle or strangle by buying the wings. And by that, I mean, we could have taken the trade that we had here, and let's just move it out in time. Looks like I erased it, I guess. Similar trade. Okay, now I don't want to do that one. Do this one. So if we take that similar trade and let's just move it out in time. Okay, so here we are at 37 days. I'm much closer to the money. Now, if I want to make a iron condor out of this, I could buy for 75 cents or thereabouts. And there we go. And for $2.11 collection, I'm going to buying power effect is $789. Maximum profit is $2.11. Probability of profit of making a penny is 69 cents, or making half, or making $1 and a nickel, about 83% on this trade in the next 37 days.
So you've drastically, enormously reduced your risk, and also enormously reduced the amount you took in.
Right. Now, where I find these trades being cantankerous is you have to keep buying insurance if you move it. By that I mean and the actual moving out the trade in time, you'll have to do. You can only trade 4 legs at a time. Once upon a time, I think they allowed 6 legs, but the trading platforms that I know of will allow you to only do 4 legs at a time. And so if we wanted to take this trade and move it out, you'd have to do the call side and the put side separate, of which you will get some friction because it's 2 separate trades there. Or you can do just the short side, roll that out in time, and then buy the wings back after it's filled. So it's iron condors are harder to manage.
Because you can't do them all in one order.
Well, no, and you're having to replace the wings, and that costs.
Right, and you can't include that in the order to roll out. You can't roll it out all in one order.
Yeah, like I would like to do 8 legs. I like to close this trade and
Right.
buy the whole, or sell the whole new one. So sell the new one. But nobody does that I found. And so from, call it laziness, I can do this. And another thing is, as if the stock goes up, for example, we could roll it out and roll this strike up from this positioning and roll it up, get it closer to this, and closer again. Okay, all right, now we're almost at a iron fly, let's say. Now, once we go to this point, we've got one more roll, and that's it.
That's right.
Okay, so that would have been the extent of management on an iron condor, because otherwise you're going to start overlapping. Whereas if the price lands up in between 175 and 180, I lose on both sides. Did that track?
Yeah, so just to summarize the discussion that has taken place in the transcript or in the chat, the first person said, you know, are you taking huge naked risks? And John has commented that you can do that, or you can add protective long trades just, you know, further out, what
That's
you're
just,
calling wings.
right. That's just what we did.
So you, and Dan has suggested buy the wings when you first trade. Eventually you may say, you know, I can handle some large losses. And
Yes.
in the worst case, I have enough winners all the time that I
Yes.
don't care about the occasional big loser.
Yeah. And if the wings make you sleep better, definitely do it. That's what insurance is for.
Yeah, so we're calling wings or insurance or outside legs, cheap junk. You can even buy
Yeah.
them way out if you want.
Oh, absolutely. So let's do an experiment here. Let's delete this one, and okay, it's 3,000, roughly $3,000. Buy this one. Okay, and I'm roughly starting to be $3,000. Move that out. Move that out again. Try to emulate the strangle with, and then generate the same buying power effect from the wing locations here. Okay, so I look at the profit. I've got a lot of credit, and I've got $7.35. See, this wing only cost me. Let me flip this from in the money. Well, no, I'll do this one. I'll flip this one back to delta. No, not delta. Extrinsic. Okay, so this one probably cost around, yeah, it's 5 and 40. I use extrinsic value since out of the many options are all extrinsic value. So it will mark around 22 cents. So you end up paying about 22 cents for that one and about 15 cents for this one. And
So the commissions may be larger than the premium.
it's approximately the same as the strangle. A slight $100 more, maybe, if I remember that old buying power number. But it's got 115 where you got 40. So you've got $40 here of potential loss until your loss stops at this point, 115. Anything drops below 115, the loss is stopped. And then,
So you're saying the margin is included in the effect on buying power. So you just look at the buying power.
exactly. So it's your buying power less the credit received.
So do people understand now? Are people understanding what this trade is? That Dan does it all the time and he's successful doing it, earning a good income doing it? But that you'd have to play with it, and the way to play with it is to use these measures that Dan has suggested for where to place the strikes.
Yeah. So another rule of thumb that, depending upon your feeling, is collecting if you sell a $10 wide spread here and here, is to roughly collect a third the width of the strike. Now, see, this where I have it right now, the probability of profit is 47%. I don't like that, so I'm going to move those up. Okay. Now I'm $10 wide, and I'm roughly collecting a third of the width of the strike. So risk reward is starting to come back into play. And again, we're at a 37-day interval. And if we were playing, I can't remember what's the next date. 51 days. We could be playing in the 51 day. So 45 days is a good sweet spot for setting up these trades. But pick one or the other. Or 37 day. That's where we are. Or 51.
So this is an important point. As you're placing these trades, you don't necessarily place them in the nearest expiry. Is that right?
Yeah, the longer out in time you're going to place it, the slower moving the trade will be. Now your theta on this one is $4 a day right now, generating that much theta. And it will get, it's not linear.
All right, so conservatively, then they should place them further out to start with.
Yes, the only, when I started, it was in a low volatility period, much like now. We're in low volatility. So these trades are not as profitable in low volatilities. And you might want to pick another trade like a calendar or something else we want to do. But I think these are excellent trades to start with, to learn, and then get comfortable with it, and then watch each one. Now, in the case of the earnings trades, you get immediately confirmation on what happens. You'll find it out the next day. But I usually go way out such that there's lots of room for the stock movement and accept less premium.
Well, that's what people should do.
Yes.
Keith has a question here. Is this the best for earnings plays because the high volatility? You can use it on non-earnings, but not as much premium to be earned because of less volatility.
Correct, but it doesn't. Time allows you to have an opportunity to manage the trade. In the case of the trade I put with 1 day to go on a Friday, it closed, and I got assigned the stock. We mentioned that earlier. I had no time to do anything. Like I couldn't. There was no recourse. You just accept the assignment and move on. So let's talk a little bit about this idea of volatility and the shape of volatility and where it comes from and those sorts of things. So do we want to continue? Volatility might be a mysterious subject to some of the folks.
Sure. I mean, we can go on a little while.
Okay. All right. What time is it? Oh, I've gone to 90 minutes plus.
Well, let's just maybe not go through the slides in detail, but just at least briefly mention.
All right. Okay. Well, let me talk about volatility. Is it's an annual sort of thing. If IV is 25 on a stock of a $200 stock, the standard deviation represents over 1 year. That'd be $50 over the next year. And there's a thing that calls, well, what is the quality, or what if the IV rank and IV percentile are two things that are on the platform. The IV rank is just where does it rank between the highest point and the lowest point, and give it a number 1 to 100. And so the higher the IV rank, the better. And hence the reason the platform does that. So this is relative to itself, is the lowest point to the highest point. Now, this IV percentile is a slightly different cut at it, because data is all sorts of points out there. But this tells you where it is relative to the others in the group. Like, here's the median price, and whether it's in the 100th percentile or lower. So what did they do on this particular example? IV is currently 22%. So this is the level, and 80% of the days over the past year have been below this particular IV. So here's a bunch of data below, and here it is above. And so between these two, if you get a high IV percentile number and a high IV rank, you don't have to look much further. That is opportunity in my mind. So again, to demonstrate the before and after, this would be the earnings announcement that we have, and the volatility just collapses. And the reason I picked data general was I did a quick plot today and plotted it, and it happened to be the one with the highest IV, and I just took a plot of the IVR and the IV percentile, added them, divided it by 2, and that's this line. And these were all of the possible earnings trades that I could have done today. And see, I think the lowest opportunity was CrowdStrike. I didn't trade that one.
So we're basically using two different measures of IV, and we're saying look for high IV by either of them, or preferably by both of them.
Absolutely, both of them. Now, the blue line is the actual implied volatility. Even though the actual implied volatility was only 40 and right before earnings, a lot of times the volatility goes up 2 weeks prior to earnings. It will start to grow, and you can see that. But I made the trade anyway. We'll see how it works out.
And Nancy was asking, where can you find the IV on Tastyworks?
Okay, let me go back into the trade platform.
And I guess which IV it is, which of those IVs it is, and
Okay.
can you see the charts that you showed?
Right. Yep. Okay. Well, first of all, let me show you what I do with this thing called watch list, and then over here, all summarized for you is the IV current. And this platform uses a VIX style IV calculation, and usually is slightly lower than TOS, but that is will be to your credit. You'll be more conservative there. And then here's the IVR in this case, and here's the IV percentile. So all I did was add these two numbers together, and got that blue line that we just looked at. Now, the IV has changed over the last 5 days. It's gone down 2.6%, or this number, 6% lower than in the past 5 days. And then here's the historical volatilities. 30 days in the IV corresponding there. Now, if you want to look at what those are, these would be the 5-day, 30-day difference, historical volatility, 30 days, the IV 30-day change, and it's just for if you're interested in that sort of stuff, but I usually don't go to that sort of detail on it. It's what it is currently.
So I think that
Okay,
answers Nancy's question.
Yeah. Okay. Now, if you wanted to go look at the actual volatilities here, the volatility of the whole stock is there, and applied volatility. Okay. Over here, you see the volatility of each time series.
For the different expires.
Yeah. I need
So
to learn how to collapse these.
So you choose a high IV before you place the trade.
Absolutely.
Okay.
You don't know where the IV is going.
Mm.
One thing you know that for an earnings trade or some announcement, there will be sometimes people trade the SPY before a Fed meeting because you'll get a slight IV enhancement there or increase. But you see the IV here is 126 with 2 days to go, and I have that trade on, and the 9 days it's 60. So we're likely to see a 60-point IV crush tomorrow immediately, and this 60 will probably go to this 64 will probably go down to 60, and this 51 will probably go down to 48, and then it's going to settle in. It looks like the long term is about 30. Can you see out in the future, 500 days away, it's 30. No difference in between that and 170.
So how is the expected move only 10 when the IV is so high? 10.76.
Well, because of the price of the options, which are based on the IV.
So they're saying it'll only go 11 points roughly. Okay.
Now, that was for the expected move. Now, a full standard deviation would have been somewhere up in this region.
Okay, thank you.
Again, 100% of the trades aren't going to fall in this bound. It's a probability thing, and you get a chance. You do 1,000 trades, it'll be really close. But you do 10, well, you might have a losing streak. But be able to survive a losing streak, even to the point of sitting down and getting out You can always go to cash and think about it. But if you put on enough trades, and in the beginning in a small account, you won't be able to put on 10 trades, likely because of the capital that you have, and you don't want to consume. I don't like to consume ever more than 50% of the capital in the account, because you need to have a room for the trade that goes wrong, or hold the position if it's put to you one way or the other, short or long.
Are they allowing you to sell naked options in retirement accounts?
Yes, like I said, that was one of my issues. I did sell a short call in my retirement account. Now, it was cash secured, and I had plenty of money in the account, but I had to deal with it immediately, because FINRA, that's not a tasty, or TOS. TOS won't let you do it, but tasty.
That's what I thought. That's what I thought.
Yeah, tasty. Well, why shouldn't you be able to trade it? It's your money. Now, granted, FINRA now, outside the rules that the risk management team at Tasty, a lot of brokers tell you that FINRA won't allow you to do it, but that's not true. It's a brokerage rule. Now, it takes more work on their side, because they have to clean up the fact that you get put short stock, and they have to call you up and send you messages that you've broken a rule, a FINRA rule. You must take action, and if you don't take action between now and about 10 o'clock tomorrow morning, they will take action. They will clear the trade to be compliant.
But you may not have enough cash covering the buyback of the short call, the short stuff that you have to buy back the short shares in your account. Depends on the size.
Yeah, absolutely.
And in an IRA, there are contribution limitations.
Yeah, and you can't automatically increase your IRA account. It's work for them to do this, but it's to your advantage.
See, I think part of the problem on it is that some things that are legal require extra accounting for tax purposes. In other words, if you borrow money in an IRA, it may not be illegal, but
well, you can't borrow money in the IRA, because the call that you shorted in the IRA account was fully cash secured. You wouldn't have been able to put the trade on in the first place if you didn't have the cash. Now, if you had to this point, if you had put on a call spread, and the size of your trade notionally was larger than your account size, and it closed in between it nearly to a full loss, but not to a full loss, and you would have been put that short stock, even in TOS, and you don't have enough money to hold it because of your size of the short call. Now,
so they would have liquidated it.
They would have liquidated it. You have been told about it. But I get put stock, short or long, about 1 in 100 times, and it's usually because I've missed a dividend payment. Now, or, you know, a dividend announcement. Let's see, let's go, do they pay a dividend? Okay, they do. And they pay 59 cents. Everybody see that right here, the dividend for
Yeah.
data January, and they're going to pay it, well, 7/10. Let's guess we had 3 months to it, 10/10 in October. But let's pretend, let's say 59 cents. So, all right, if I was holding, well, I can't add a, got to clear that. I was holding this stock short for $25, and it became anything below 59 cents is subject to be exercised. Anything above that 59 cents, this point above, I won't get exercised because it will cost them money to exercise it to get the dividend. Trader hack.
Yeah. Like, should we be looking for more questions now, Dan, or did you want, or is there more material you want to get through?
Well, we were going to start talking about kurtosis, but that's a mule of a different hue there, and maybe that's enough for this evening. Which was
Well, why do you, since you prepared it, well, like, why do you mention it in a minute and then we'll go on?
All right.
Just
Okay.
cover-
Let me flip, get out of there. And usually sometimes people call it fat tails, kurtosis, or that sort of thing. But let's go to a diagram here and so you can understand the concept. So normal distribution is this red curve. And this blue one is a kurtosis of 4. And then the green one is a kurtosis of 7. So the to give you an example, I think SPY has a kurtosis of like 12 or higher. So it's very peaked. Now, as the IV goes up, meaning the distribution widens out, the height of this curve is higher. And this is what yields a lot of the increased premium value for that compared to the low volatility or the very narrow type volatility situations. So
this is why we have richly priced tails.
Yeah. So this again, yeah, this was the SPY kurtosis in this particular data sample was 12.1, and the normal distribution was 0 in this particular piece of work. And giving you an example of SPY 175, gold of 138, and normal was 0.26. But as the normal distribution is higher than the examples here, they're going to be fewer of outlier situations occur in those regions. So it's to your advantage to have those particular situations. All right, I guess that was it. And then the next bit of work, and people can read about it, is I guess about the IV, how IV is calculated, and this very precise way. It's really published a lot, but that gives you the S&P 500 monitoring the whole market VIX. And then talking about the different methods. The TOS use, somebody help me with is it a Swedish name versus the Black-Scholes models? With Black-Scholes, European options with can only be exercised at the expiry date, and then American options, you can exercise them anytime. Okay, and then this was just a note on the different binomial trees that were used, and going and backing into it with assume your option prices are correct, and then backing in to the price of where the volatility ends up. And I think we covered this one, Don, about, first you build it up from the strike value, each individual strike, and then you see the time series and then the actual stock IV. And then we were looking at the stock IV as a comparison. And there was a slide that went over what I showed you on the platform. I go to the watch list on Tasty Trade. On TOS, I actually went to the today's option statistics, and then that will give you the whole IV for the current IV percentile tab. If you're happen to be using TOS. All right, basically that was, and voila, keep a trade journal and write down where you are, or I find I still write down in the TOS. It required me to keep a journal there to quickly have a number of where I was, and Tastyworks, it seems to do a pretty good job of keeping that up for you. Right, we showed that's what we jumped to before, and I was going to go over another trade analysis there. In this particular example, I'm in this position right now with the PayPal status, and you notice that the call is at 60 and the put is 65. So I'm inverted from where I started. I started with the call at 85 and the put at 65. So I rolled it, and went past. You would not be able to do this with an iron condor. And so I've got $5 of intrinsic value here. I've only collected 487. This is a losing trade. This 125 will decrease until I'm $13, and then the trade's over. And so I lose 13 bucks in the next 16 days. So I'm faced with, do I roll this out in time? And that's a total option. And then I would uninvert, and I would roll it out, because remember, there's put call parity. There's no difference in the short 65 call and 60 than to drag them over to the other side and put them the same strikes in the money and pay a debit. And then you'll probably be pretty close to what is the stock today, about 63 something. So it's still pretty much in the middle. You might could roll it for near nothing. but we won't demonstrate that. All right, resources be included in the talk, in the slides. And summary, I think we touched upon everything. All right, in closing, don't fall in love with your position. It's okay to lose sometimes, but learn from your losers. Now, I'll include what we talked about here, a lot of the ideas I had. I just did a listing of ideas there that you might find useful. And may the odds be with you. And keep the black swans in the other pond.
On the other pond, I like that.
All right, that's it. Don,
Okay,
I
thank you
wore
very
out.
much, Dan. Now, let's see, do we have,
Questions again?
sorry?
Any questions? I'll stay here as long as you want.
You mentioned about stop loss. So do you put a stop loss or you don't on your last slide?
There, on this one?
Yeah, it said about stop loss.
Okay, stop losses.
Mhm.
I think they're dangerous in times of market turmoil. Now, and you'll get these happenings and you'll get the stock go up or down and options go along with the stocks and you'll get exercised. And then it comes right back again. So all you've done is lose on the trade just because of a market, bad mark even. And so I'm not comfortable with stop losses. I am comfortable with putting on trades or closing positions and letting them sit and wait for the profit. But I watch them, and then I would rather put alerts on to tell you to send a note to your phone that something is happening, and then go into your phone and close the trade or roll it or do whatever. Then you respond versus somebody else just doing it. I don't like bill pay either by a computer taking money out of my checking account either. But I'm not in control of that. I would rather write the electronic payment myself when I want it.
So you do alerts on tasks? I mean, on Tastyworks?
I did what?
Can you do alerts on Tastyworks?
Alerts, yes.
Oh, if you can show us next time.
Okay. Yeah. In the control system, you just put your email address in there, and any communications it will send there. And every trade that I make, they send me a email to it, and also a message on the phone if you want it.
Okay, thank you.
Okay. Any other questions?
Well, first of all, yeah, people are commenting here on the alerts. They say, those work. Let me see what else.
They're delayed 10, 20 seconds.
Say again?
I said, I have experienced 10 to 20 second delay between the time that I see it on my computer till the time my phone beeps.
Okay.
Now, same thing if you put an alert for if a stock reaches a threshold or whatever alert you're on. Networks get busy, and in a high trading period, platforms do bog down. But it's another black swan.
Lindsay says SPX has bid-ask strikes that will get executed with stop-loss orders. Now, do you mean if the bid-ask spread widens, will that itself run the risk of an alert?
I would say it would be just the mark, not necessarily the bid ask.
See, if you're just like, if you're short a particular strike and the bid-ask spread widens, they may hold you against the worst side of the spread, I'm afraid.
Well, they have to give you the best price.
On a fill, but on the alerts, for their margining purposes, they may do those off the worst side of the bid ask. Maybe not. I mean,
Well, if you did it on a chart, usually the last trade is a real number. If you did it on, and usually that's what's plotted, is the
Okay.
actual last quote. I mean, not last quote, the last
Yeah,
trade.
but they can't take the risk of waiting for another trade in their margining system. They'll, if it were margin, they'll take it off the bid ask. Some brokers will, that's all.
I never do margin. I have a margin account, but use no margin. But I don't ever.
Well, that's very significant.
Yes. Now, I have a margin account, but trading options does not consume any. The only time you're given 50%, if you have $100,000, you could probably trade $200,000 worth of stock until you break it. But you're not charged any expenses or interest as long as you stay below that.
But how about spikes? Could you get spikes just in the SPX quote one way or another that would give you a false alert? A false stop order, would trigger a stop order.
Well, it could trigger, well, who knows exactly what happened whenever the trades get masked, but because there's too much volume that the pipes can't handle. And usually there's I guess you're worried about the case of really high volume event happens. 9/11 happens.
Yeah.
And that clogs up everything, and then it has to be filtered out. They filled it, but it was an erroneous fill, and they had to back it out. Or if it's big bucks, they end up in court.
Mm-hmm. Yeah, now Lindsay says a stop loss will get hit sometimes because the bid ask gets too wide on big indexes like SPX. He says it's happened to him more than once.
And how far out is he on Delta? Or how far away from the current strike prices?
Are these far out of the money, Lindsay? He says he contested these fills with toss, and that was the reason they gave me. So he's not doing stop loss orders on indexes any further.
Well, I don't do it, so I don't know.
Okay, fair enough. Okay, any more? Yazid asks, how about risk ratio? Any recommendations?
Risk ratios. Okay.
Which risk ratio? I don't know.
Well, I kind of touched upon it whenever I was discussing the iron condors and trying to get 30% of the width of the strikes. So if you had a $10 wide strike trying to get $3, that's a risk ratio in my head.
Risk ratio. Okay, yeah, that is. Yazid, did you have any thoughts of your own? I mean, obviously you can reduce your risk by adding wings or adding long positions that are further out of the money, as Dan discussed.
I would add one way to, I didn't say this, but it's better, I think it's in the write-up here, like it's better to trade one $10 wide vertical than 10 $1 wide verticals. They'll be the same risk. But because of the deltas there and the way that works, it's more risky to trade. To whenever you're scaling up, don't scale up to get that next exposure with just increasing the number of contracts. Widen it out. Widen
That's
the
an
wings.
excellent point, because theoretically, if the stock goes to 0 or to infinity, you'll have 10 times infinity exposure if you have 10.
Yeah, well, I was doing a vertical there, which was a defined risk trade.
So that wouldn't apply.
No,
Okay.
but still, because the $1 wide vertical, the deltas are much closer together than the $10 wide one is.
So the overall delta will change much less.
Exactly, and so it's better to trade wider wings there than just increasing the number of contracts.
Does that mean the gamma is much lower?
I hadn't thought of it that way. You're at the same time and nothing's changing, and
Well, yeah, I think because gamma is your position, because gamma is the rate of change of delta with change in the underlying, right? So we're saying that the rate is much higher with multiple positions. So I think it must be, but I haven't really, I don't know either.
Yeah. Well, at getting close to expiration, yes, gamma would be involved. But if you're 1 month out or more, 2 months out, I don't know that
It's all going to be softer. Everything's going to be softer.
Yeah.
Well, and John S says 10 1-wide contracts is what riskier than 1 10-wide, which is, I think, he agrees. He's agreeing.
Mm-hmm.
Well, thank you.
It's just you're tempted to do what you've been doing, and so human nature is just to do more of it. I'll get more because I do more of it. That's not true. Counterintuitive a bit.
It's true at the That's a very interesting example. We could go into the Greeks, but we could go into the Greeks too, in depth on that. But that's the intuitive idea. Well, thank you very much, Dan. I mean, I think you've given everybody tremendous insight into, first of all, the tools you use to do your trading and to do a quantitative analysis of your trading. And second, you've showed us how you apply it in the successful trading that you do using options and using calendar spreads in particular. Thank you very much. Please send the slides, Nancy. They're on. I posted the link to that. Oh yeah, but so Dan will. I'll give you the video. Okay, yeah, we'll send an email or check our website for the slides. But you are Dan will give us the slides.
Yeah, I'll clean it up and gen out a PDF for it. You'll have that tomorrow.
Super. Well, thank you very much again. Is it Meetup site? I tell you what I'm gonna do. I'm gonna start putting, I will try and put the, yes, on the Meetup side. And you know what? I think I'm gonna try if I can and start putting the the link to the presentation on the YouTube side as well. Because I know that people on YouTube, a lot of people just go directly to the YouTube side. Or at very least, I'll put a link to the Meetup site and you can get it there. And okay, yeah, thank you for everyone for contributing also. And thanks again, and we will call it a night.
Okay, good night.
Good night. Thanks, Dan.
Thank you.